Alright, in this video we're going to build on taking the idea of analyzing a cost table with a pure competition or perfectly competitive firm, and we're going to look at, okay, in pure competition, we're assuming that there are a lot of little firms all producing the exact same thing. And usually we add one other assumption, and that is that most of these little firms are going to be pretty much alike in terms of their cost structure. Also, remember that it's going to be easy to enter into this industry and easy to exit out of this industry. And so we want to think about how all these assumptions work together in order to determine the behavior of the entire market. So what we're going to do today is briefly review the ideas involved with a cost table. I've got a cost table here with a few blanks that we'll fill in and briefly review those ideas. And I've already graphed the marginal cost, average total cost, and average variable cost here. And what we're going to do is, in the end, assume, okay, what if there were exactly 100 of these little firms? What can we do to use the information we know about the behavior in terms of how many units each individual firm would want to produce at different prices in order to build what the market supply curve would look like in the entire market. And we're going to draw that market supply curve over here and assume we're given a demand curve by somebody else. That's somebody else's job. We're going to see where the supply and the demand curve intersect and determine what the market price would actually be if there were 100 firms. Now, I have 2 pages on this handout, and as always, before you keep watching this video, please click to download and print out the handout so that you can do this along with me. There's no substitute for actually doing this. Now, to help you practice, I have a second page where everything is blank, just as it would look if you were given this on a test. So let's look at this cost table first, and let's fill in the missing values here. So we're given the quantities we might want to produce as this small firm, 0 through 10, and the total cost. This is what you're going to be given when you have to fill out these tables. Everything else over here you're going to have to figure out how to fill out. Now, to save us time today, I've filled most of it out, but let's fill out the rest of it. So the first thing you're going to want to figure out when you look at a cost table is, what is the fixed cost for this firm? In other words, if this firm were to produce no units, they're not going to have any variable costs. Fixed costs plus variable costs equals the total cost. And variable costs are things like labor and materials that you use more of when you actually produce more units. So if you're not producing any units here, and your total cost is $50, the trick is knowing that all $50, when you're producing no units, must be your fixed costs, because you can't have any variable costs when you're producing no units. And variable costs increase, as we see here, as we produce more units. Fixed costs, the reason we call them fixed, it's not that they couldn't change next month or next year, it's that today, as we produce more units, the fixed costs do not increase or decrease for that matter. So the fixed costs are always $50 for this firm, at least today, as they produce more units. So we could just say it's the same all the way down, $50. Doesn't go up. We don't use more fixed costs as we produce more units. That's what we call the variable costs. Now, completing the rest of the top row here, we have AFC, AVC, ATC, and MC. Average fixed cost, average variable, and average total. When we say average, what we mean is we want to divide it by the quantity of units we're producing in order to get a per unit. So how much are we spending per unit on these things? So what we do is we take the cost we're talking about here, fixed cost, $50, and we divide it by how many units we're producing, 0. But you can't divide by 0, so that's why average fixed cost here, we just say it's not applicable, or we draw a line through it because it's not something you can calculate. And here average variable cost is going to be 0 divided by 0. We can't do that either, so not applicable. Average total cost would be 50 divided by 0. Well, we can't do that either. Now, marginal cost asks how much additional money does it cost to produce each individual additional unit. We see here when we go from producing 0 to 1 unit, the additional cost is 30. That's why the marginal cost here is 30 for the first unit. The marginal cost is 10 for the second unit because our total cost goes from 80 to 90. By the way, our variable costs goes from 30 to 40. So the marginal cost can either be the change in the total cost or the change in the variable cost. They'll always be the same because the variable cost is the only one that's actually changing. But marginal cost for 0 unit doesn't make sense to talk about, so we cross that one out too. Now, to give us some more practice, I've also left row 7 here blank. So if we have $216 in total costs, and 50 of those are fixed costs, how much must be the variable costs, like labor and materials, instead of things like fixed costs, like rent or normal profit, the payment that needs to go to that entrepreneur? Well, we take 216 minus the 50 to get the variable costs, $166. Average fixed costs. We just take the 50 and we divide it by the number of units we're producing. So it's always 50 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Here we want $50 divided by 7. So $50 divided by 7 gives us, you do it along with me, $7.14. Average variable costs. We're asking if we take those variable costs of $166 and we divided those by 7 units, we want to know how much are we spending on labor and materials costs per unit. So what's 166 divided by 7? I'm getting $23.71. How about average total cost? Here we want to know if we take all of our costs that we have to pay for all of our resources and we divide it by how many units we're producing, how much is that per unit? And this is good to be able to compare to the price. If the price is bigger than the total cost per unit, we have to be able to make a profit. If the price is lower than the total cost per unit, we're going to lose money. And if it's equal, we'll break even. So we take the 216 divided by 7 units. What do you get? $30.86. And lastly, for the 7th unit, how much does that 1 unit cost when we produce it? How much do our costs go up when we make the decision to produce that 7th unit? That's how much the 7th unit costs us to produce. So our total costs go from 180 to 216. Variable costs go from 130 to 166. That additional cost is always going to be the same for the change in total or the change in variable costs. Looks like it's $36 for the marginal cost of the 7th unit. So now that we've got our table filled out, and we've reminded ourselves what everything means and how it's going to be calculated, we'll look at our graph just to remind ourselves of the shapes of these curves that we should always expect. The marginal cost kind of looks like a check mark shape. The average total cost and the average variable cost have that kind of U shape, although one side of the U is going to be stretched out to the right. Also remember that the minimum average total cost and the minimum average variable cost are going to occur right around where that marginal cost curve crosses through them. And the reason is that when we're adding in producing units that cost less than average, that's going to bring our average cost down. But as we add in units that cost more than our average, that starts to bring that average back up again. So that helps us determine where that minimum is going to be. Now also recall that we want to find 2 prices in our table, the shutdown price and the break-even price. The shutdown price tells us if the price gets below this, our best option is to shut down and produce 0 units. So do you remember how we figured that out? The shutdown price is the minimum average variable cost. So we look at the average variable cost column and we find the lowest it gets, $18.33. That's also going to correspond with this point on the graph here, where the average variable cost is being pulled down as the marginal cost is below it. But right here, the marginal cost is a little bit above that average, so it pulls that pink average variable cost up just a little bit. So that's our shutdown price, $18.33. So if we ever see a price below $18.33, our best option is to produce 0 units today. What about the break-even price? The break-even price, as we were talking about a minute ago, has to do with average total cost. And the break-even price is the minimum average total cost, because we know if the lowest average total cost ever gets, well, it's $30, and the average total cost is $30 when we're producing either 5 or 6 units. The reason why that's the break-even price is because if the price were, say, $29, we know that there is absolutely no way we can produce this product on a per unit basis for less than $30 per unit. So there's no way we can make a profit if the price gets below that 30, because that's the cheapest per unit we can produce this thing for. Also remember that if we shut down, our total revenue is going to be 0 because we're producing nothing, but we still have total costs equal to the fixed costs of $50. So we'll lose 50 if we choose to shut down, but sometimes that's the best we can do. All right, so the break-even price is $30 for this firm. So that just gives us a very quick and easy way to determine if we see a market price below 30, we know we're going to lose money. The profit will be negative. If the price is above 30, we know we're going to make a profit. And if the price happens to be equal to $30, we're going to break even. And the last quick reminder is that breaking even to an economist, when we're talking about economic profit, breaking even, you're not sad about that, because economists, when we calculate profit, we account for all the costs, including the cost of the entrepreneur's time and energy and risk-taking and all that kind of stuff. So when you're breaking even, you're not sad. You're still being paid, but you're just being paid the minimum amount to keep you interested in keeping this business going. So you are making kind of the expected amount that you kind of might have thought that you were going to make when you got into this business to start with. So let's review our decision-making process. If we were this little firm, or we were advising this little perfectly competitive firm or purely competitive firm, what they do is they take the market price as given. They can't affect it. They're too small. And if they disappeared, nobody would notice. So they're such a small firm, they can't have an impact on the market all by themselves. So what they do is they try to figure out, hey, what's the market price? Suppose there was a market, maybe an agricultural market. You could call up the market and say, hey, how much is this going for today? And they tell you, okay, suppose that today the market price was $18. That's what they told you, and now you have to decide how many units should you produce. The rule is to ignore the downward sloping part of the marginal cost curve, so that would be here, and start where the marginal cost curve bottoms out. Okay, well that's right here at the second unit, and then start asking the question, for that second unit, the marginal cost is $10. If I can sell that for $18 and it costs me $10 to produce, should I produce it? And you'd say, sure, that sounds like a good idea because it costs me 10 to make. I can sell it for 18. Let's do that. What about the third unit? Well, it's going to cost you $15 to make, and you can sell it for 18. Sounds like a good idea. What about the fourth unit? It's going to cost you 19, sell it for 18. Well, no, that doesn't sound like a good idea. So if we were going to produce, we should produce 3 units, and we should stop there. However, wait a minute. Should we produce anything at all if the price is $18? The answer is no, we shouldn't. And that's where we get into this shutdown price. Shutdown price is $18.33. And that $18.33 tells us that if we produce at any price below $18.33, we've made a mistake, because we're going to lose more than how much we would lose if we shut down altogether, which is $50. Now let's just verify that that's true. What if we did actually decide to produce here? We produced these 3 units and then we stopped. Let's calculate what would happen to us. Well, our total revenue would be 3 units times $18. So 3 times $18 is $54 in revenue. How much are our total costs when we're producing 3 units? Well, we look over here at 3 units, $105. Total cost, $105. Total revenue minus total cost, 54 minus 105 is, we're going to lose $51. Well, that would be a terrible idea, because if we just tell our employees to stay home and produce 0 units, we could lose $50 instead. So our best option is not to produce the 3 units, it is to shut down and produce 0. Now, we didn't actually have to go through all that we just did to prove that, as long as we trust that shutdown price. The minimum average variable cost tells us if you produce at any price below that, you're going to lose more money than if you shut down. Now, let me spend one more minute just explaining why this is. Let's think about this in terms of producer surplus. Let's calculate what's going on here that way. Remember, the idea of producer surplus is total revenue minus variable costs. In this example, total revenue was $54, or that 3 times 18. If we subtract off variable costs, our variable costs here when we're producing 3 units are $55 equals minus $1 in producer surplus. So producer surplus is the amount of money a business has left over after it pays its variable costs. And what it uses that producer surplus for is to try to pay off its fixed costs. But the problem here, when you produce, if the price is below the minimum average variable cost, below that shutdown price, not only do you have 0 producer surplus, it's worse than that. You don't have any money to try to pay off any of your fixed costs. You actually have to come up with another dollar from somewhere just to pay the variable costs. Your variable costs are bigger than all of your revenue that you brought in for selling the product. So by producing, you're digging a deeper hole. So this is where that shutdown price comes from. The inability to even cover your variable costs with the price that you're selling for. So the real answer to this question, at a market price of 18, you don't have to go through all this stuff. Just say quantity equals 0 and you're going to lose your fixed costs. You still have to pay those fixed costs even if you produce 0 units. So that would be our answer. Very quick and simple. Just compare the price to the shutdown price. All right, well, now suppose the market price was $36. Let's see what the firm should do in this case. Now it's the same kind of procedure. Ignore the downward sloping part of the marginal cost curve, or go to the point where marginal cost is at its minimum, and then start asking the question, if I can produce this second unit for $10 and I can sell it for $36, sounds like a good idea. If I can produce the third one for $15 and sell it for $36, good idea. If I can sell the fourth one for $36 and it only costs me $19 to produce, sounds like a good idea. And this one costs $26, sell it for $36. This one costs $30, sell it for $36. This one costs $36 and I can sell it for $36. Should we do that? And this might sound like a trick question, but it's an answer that you have to be prepared to give the right answer. The rule for how much to produce says, keep producing as long as the price is greater than or equal to the marginal cost. And since that price of 36 is equal to the marginal cost of 36, the answer we want to hear is go ahead and produce it. You're not losing anything by producing it, but you are going to be helping your employees by keeping them longer and paying them more. And when a firm starts to get into trouble, one of the worst things that can happen that a firm can never rebound from is if it starts to lose its employees, because you're going to lose your best employees first. They're going to be the ones that have the easiest time finding a better job than the one you're giving them. So making your employees happy is extremely important. So our answer in this case would be, since we're going to keep producing until the price equals the marginal cost, or if we ever get to a unit where the marginal cost is bigger than the price, we never want to produce that one, right? So we certainly don't want to produce the 8th. But the 7th, okay, we're fine with that. So what should the firm do here? Well, we should produce 7 units, so Q equals 7. And of course, we see here, because the marginal cost is going up, as the price gets higher, we're going to want to produce more units. That's important coming up. But the quantity is 7. The price is 36. So total revenue, 36 times 7, $252. So total revenue, price times quantity, $252. How much is the total cost? Let's see here. Total cost is $216. And our profit is $252 minus $216, $36. But keep in mind that that $36 isn't really all the profit that we're making. You could call this excess profit, or sometimes economists will call this extraordinary profit. Because we include a little bit of profit, we call normal profit, in the costs. It's one of the fixed costs. If you're not paying the entrepreneur, you're not going to be able to keep that resource interested in being in this industry. So this $36 is profit over and above that minimum that the entrepreneur needed to keep them interested. So this entrepreneur is overjoyed that they're getting more profit than what they desire, or that minimum that they need to keep them interested in this industry. Let's look at this profit calculation one other way. Because a lot of people learn graphically. Some people like formulas better. Some people like graphs better. I'm one of the people that likes to think about things in terms of graphs. And this is one thing we want you to think about in this course as well, the graphical interpretation of what's going on. So let's tackle that real quickly. Let me add a line here at that price of $36. All right, so here we have a blue line at the price of $36. And we see that what we want to do is produce as long as the price is greater than or equal to marginal cost. So what that's telling us is that we don't want to produce any of these units where the marginal cost is bigger than that price. Now, what else is going on here? Well, it tells us we want to stop at 7 units. So let's draw a little line here at 7 units and focus our attention on what's going on at 7 units. We see here that the price is equal to the marginal cost at 36. We can also see that that price of 36 is higher than the average total cost. Let me label that right here. Average total cost, there's the price. Nope, here's marginal cost. Here's average variable cost. So the price of 36 is bigger than the average total cost. Now that distance there between, let me do this in purple, that distance right there between the price and the average total cost, you can think about that as the profit, but not the total profit, but the profit per unit. Let's use the table to help us understand what I'm trying to say here. If the price is $36 and the average total cost, let's look that up, when we're producing 7 units, is $30.86. So the average total cost, $30.86. That 36 minus $30.86 tells us that we're making about $5.14 in profit each, or per unit. So that's what that distance is right there, from 30 down to $30.86, okay? Now, how could we calculate the total profit from that $5.14? Well, what we could do is we could multiply the $5.14 times 7, right? Because we're getting $5.14 in profit for each of 7 units. So if we calculate the area of this yellow rectangle here, which is $5.14 high times 7 units long, 514 times 7 gives us $35.98. And that is the profit that we calculated over here. Almost. Now there is a slight difference, and the difference is rounding error. Why we're not getting exactly the same thing as $36 is this $30.86 here is rounded. If you really take the total cost of $216 and you divide it by 7, you don't get $30.86 exactly. We rounded that number a little bit. And so when we get the profit per unit, there's a little rounding error there in that $5.14. So when we multiply it by 7, we get a tiny bit of error in the calculation. And that's okay. That's not something we're going to obsess over. There's a little bit of rounding error when we do these kinds of problems sometimes. As long as we're getting within 2 cents, right? That's pretty darn close to our profit calculation. $35.98 or $36, that's practically the same thing. So you can either think about this profit calculation as total revenue minus total costs, or how much profit per unit am I getting, which is price minus average total cost, and multiply that times how many units. Profit per unit times the number of units gives you the total profit, or a very, very close approximation if there's some rounding error. All right, this brings us to the main event. The main event here is for us to understand where supply curves come from. Where does a market supply curve come from? You begin a microeconomics class talking about supply and demand curves, and now we're ending by analyzing businesses and seeing where the supply curve actually comes from. So again, we're assuming we're in pure competition, where there's a lot of little firms all producing the same thing. Each of them are too small to have an impact on the market by themselves. So what we're going to do here to keep the math simple is we're going to say a lot of firms. Well, how many is that? Well, let's assume it's 100, because 100 keeps the math simple. So let's assume that there are exactly 100 firms, and that each of these 100 firms are exactly like this one that we've graphed the cost curves for over here. Here's how you draw a supply curve. We ask the question, for each market price, how many units would this one firm want to produce, and multiply it by 100. Multiply the quantity by 100. Let me show you what I mean. Now we just figured out that here at the market price of $36, that this firm should produce 7 units. So what if we're looking over here at the entire market, and in the entire market we had a price of $36, right? We can just extend this blue line all the way over here. If each of 100 firms are each producing 7 units, 7 units times 100 little firms, altogether, these people have to be producing 700 units. So if we follow this line over here, this $36, and we go down and we find 700 units being produced, 7 each times 100 firms, then we'd mark this point right over here. Must be 1 point on the market supply curve. So again, that logic is if one firm would produce 7 units at a price of 36, then the quantity supplied by 100 little firms must be about 700. And now we need to figure out, what does the rest of this supply curve look like if we have 100 little firms? And here's the way we do it. Remember that how a little firm determines how much to produce is they just look at keeping producing as long as the price is greater than or equal to the marginal cost. So the easiest way to do this is just to look at the table here, and let's start at the highest marginal cost on this table, right here, this $50. And if the market price was $50, what quantity would this one little firm want to produce? Well, since they're going to keep producing as long as the price is bigger than or equal to marginal cost, they would want to produce 10 units. Okay, one firm produces 10 units. 100 firms produce 10 times 100. What's 10 times 100? 1,000 units. So another point on our market supply curve is going to be, if the price was $50, the quantity would be 10 times 100, or 1,000. All right, so down here is 1,000 units. We go up here to a price of 50, and there's a point on our market supply curve right there. And then we just keep moving down. What if the price was less than 50? 49, 48, 47, 46, 45. If the price got all the way down to 45, then each little firm would produce 9 units. And 9 times 100 is 900 units. So, at a price of 45, if the market price was 45, the market quantity supplied would be 9 times 100, or 900 units. Okay, so $45, 900 units. Here is another point on our market supply curve. And we just keep going down and connecting these points. So make sure you're doing this along with me here. If the market price was 39, each firm would produce 8 units. 8 times 100 is 800. So $39, 800 units. And we already plotted $36 and 700 units. The next marginal cost is $30 and 600 units. $30, 600 units. Alrighty, right there. And connect the dots. Next one here is $26 and 5 units. $26, 500 units. Look, now we see where the supply curve intersects this demand curve. And again, this demand curve is going to be given to us. But let's keep going. Let's finish the rest of the supply curve here. What if the market price was $19? 4 units times 100 is 400. So 19 and 400. And what if the market price was $15? How many units would each little firm want to produce? No, it's not 3 units. This is the only really tricky part right here. Suppose the market price was $15. Let's just start from scratch. Let's take a step back. How many units would each firm want to produce if the market price was $15? Well, since the shutdown price is that $18.33, the answer is going to be 0 units. So we have to change up our game here just a little bit at the very end. We can't put a price on a market supply curve and say that firms are going to supply anything there if it's below the shutdown price. Because if the price is below the shutdown price, every firm is going to produce 0 units. So we'd have a total supply of 0 units. So here's the way to finish up a supply curve. We need to plot that shutdown price, $18.33, and we need to ask ourselves, if the market price was $18.33 exactly, how many units would each firm produce? And the answer is, again, look at the lowest marginal cost and say, okay, we'd produce the second one, we'd produce the third one, but not the fourth one. So our last point on the supply curve is going to be the shutdown price. And I personally usually draw this in a different color just to make sure everybody knows where that came from. And 300 units would be produced by all the firms at that price. So 300 units, just a little above $18. And let's just label that carefully, so we remember where that comes from. And that is where our supply curve ends. unless we want to be technical about it. Let's be technical this time. What we kind of want to do if we're really drawing a supply curve in a market, we want to include what would happen if the price was lower than 1833 and indicate that the quantity supplied would be zero. So let's go ahead and do that. So at any price below that 1833, the rest of the supply curve is going to be over here at a quantity supplied of zero. And what some people will do is draw a little dotted line to indicate that at a price below 1833, all of a sudden, every firm decides to shut down and produce zero. So what we see here is the market price, where the supply curve intersects the demand. We're looking for at what price does the quantity supplied equal the quantity demanded. What we see is right here that it looks like the market price would be $26 and the quantity would be 500 units. So the last question we want to answer is, okay, if the market price actually is $26, what would each little firm want to do? Well, they would want to produce the second unit, the third unit, the fourth unit, and the fifth unit, and then stop. So the quantity would be 5. Are they going to make a profit? Well, that price of 26 is below the break-even price of 30, so no, they're going to lose money. And let's just calculate how much that's going to be. Their total revenue is going to be 5 times 26, or $130. Their total cost when they're producing 5 units is $150. And yes, they're going to be losing money. They're going to lose $20 today. Or you could say their profit is negative $20. So they're going to lose 20 or their profit is negative 20. So are they going to shut down and produce zero today? Or are they going to actually go to work and produce this 5 units? Well, because this price is not below the shutdown price of 1833, they're going to produce. And again, why that is by producing the 5 units, they're going to earn some producer surplus. And they're only going to lose $20. Whereas their other option would be to shut down and produce zero, and in that case, they would lose $50. Their total revenue is going to be nothing, and their costs are going to be $50. So it's much better to lose $20 today than it is to lose $50 today. So the firm will not shut down. But let's remember that shutting down is a short-run concept. All we mean by shut down is today you close your doors. In the next chapter, what we're going to look at in chapter 11 is long-run behavior. How does what we're saying here change if we're asking the question, in the long run, what should this firm do? Now, what they could do, some of their options are they could expand, maybe make their factory bigger. They could make their factory smaller. They could exit this industry altogether. And that's going to be our answer for a firm like this. If you're losing $20 today, that means that you're not able to pay all of your resources, and you can't keep that up forever. And so in the long run, you're going to exit the industry. Shut down is not what we call it when you permanently close down. Shutting down is just produce zero today. In chapter 11, we'll talk about exiting the industry, which is a permanent thing. And all these resources will find a better home where they can be more productive. So make sure that you practice this, that you sit down and on this blank version, you are able to go through and do all of this, and you can explain it all to yourself, and you understand what you're doing. And as always, if you have any questions, please don't hesitate to ask. I'll be happy to try to clarify anything. It's Dr. Berkey signing out for today. As always, I wish you the best of luck with your studies. Bye-bye now.